What's up, guys? This video is going to be on things that you shouldn't do when you're trading the inverse fair value gap strategy. That's the strategy that I use and that I make all my videos on and try to teach people. These are things that will lower the probability of your trades, and if you follow all of these, then your trades should be like a 90% win rate. It's very consistent as long as you follow these. These are very essential things, so make sure you guys follow these when you're trading the strategy, and let's get into it. Now, the first mistake is going to be using a setup with multiple fair value gaps. Now, you can see here, we got a liquidity sweep, and if we inverse this fair value gap here, then we will have a short setup, right? You can see here, we inverse this fair value gap. Let's say we enter into a short here with our TP down here. Let's see what happens, right? We inverse this fair value gap, right? That's what the strategy says. Liquidity sweep right here and inversing this fair value gap. Let's see what happens. And on this very next candle, we close back above this fair value gap, and that is us getting stopped out. And then what does price do? It pumps. So the problem with using multiple fair value gaps is you can see right here, we rejected this fair value gap, the second one. So when it inverses this first one, we don't know if it's gonna inverse the second one as well. So it could inverse this one as well, but we don't know that. So to have the highest probability, what you would want to do here is go on a higher time frame. Now, this is another one of the rules that I was going to go over in this video, is you want to use the highest time frame that the fair value gap has. So we can see here we're on the 30-second. If I go to the 1 minute, we have this fair value gap. So what we should have done instead of looking at the 30-second is we see we have this 1 minute. Now let's check the 2 minute. There's no 2 minute. So the highest version of the highest time frame this setup appears on is the 1 minute. So if we draw this trade, let's see if we get the inverse. You can see no setup and you wouldn't have lost at all. So that is kind of 2-in-1. You want to use the highest time frame possible for this fair value gap. And you also don't want to take any trades with multiple fair value gaps. Now, I personally don't trade on anything higher than the 3-minute time frame. So if you're zooming out time frames to get a singular fair value gap instead of multiple, and there's still multiple on the 3, and then you go on the 5 minute and there's a singular, I personally don't trade anything higher than the 3 minute, just because it takes so long for the candles to close, and that's what I base my trades off of, is the close of the candles. So I personally don't trade on anything higher than the 3 minute because it just takes too long for the candle to close. All right, now for this example, we have a liquidity sweep and a fair value gap right here. And if we were to inverse this, we could have a long, right? You could do break even here and full TP here if you were to take this. Now the problem with this is that this fair value gap is too small, right? And a lot of being able to tell if the fair value gap is too small will come with screen time. But you can see here that if we were to draw out from the top of this fair value gap to the bottom, you can see that it is 3 points, and that is a very small fair value gap. And the problem with these smaller fair value gaps is when they are so small, they don't hold much weight in the market. The imbalance is not big enough to actually cause anything to happen or indicate anything if it gets inversed, because the imbalance is so small, it doesn't hold any real weight in the market. So you can see here, we get an inverse of this very small fair value gap. We enter into a long with the take profit up here at this external liquidity, and then right here, we can make this be the break even, right? And you can see right here, you get stopped within a couple candles, close below, close the position, and that's how that trade would play out. That is one of the things that will pretty much just come with screen time, is being able to tell how big a fair value gap should be and how small is too small. That is just something that will come with screen time because a lot of it is just relative to the current volume in the market. And with that being said, we're going to get on to the next example. All right, now this next example is going to be on if we don't get delivery from a fair value gap or a liquidity sweep. So you can see here we have this fair value gap, which you could also say is too small because you can see it's only 2 points. But for this example, I will be showing the fact that we don't get a liquidity sweep or delivery from a fair value gap. So you can see here that we close below, so we will enter into a sell. With this, you could use this as the target right here. So full TP would be here at this close internal liquidity. And you can see that right here, we close above, and that is our stop loss, right? And you can see that it didn't work, and this was the best example I could find because this normally doesn't happen. It's rare that this happens, that we get an inverse fair value gap from nothing because there's liquidity everywhere. Each swing high and swing low is liquidity. So this is the best example I could find of this. But you don't want to take an inverse fair value gap by itself. You want it to at least follow the basic rules for this strategy. All right, this final example has a few things wrong with it, but the main thing I want to focus on is taking the internal liquidity first. Now, what do I mean by this? Well, when we inverse a fair value gap, you have to wait for the candle to close. So when that candle is closed, did we already take out the nearest internal liquidity before inversing that fair value gap? So on this example, I will draw out this fair value gap, right? And if we wait to see if we get an inverse, you can see right here, we get this close below this fair value gap. So this is an inverse fair value gap. So you could short this, but, right, let's say we're to draw this out, but what do we notice? Back here, we created this swing low, which created some sell side liquidity here, right? This sell side liquidity got taken when we inverse this fair value gap right here. So this trade is invalid because we already swept this internal liquidity right here, right? We swept this internal liquidity. So now this trade is completely invalid, right? And let's see if we were to enter here. If we were to enter here, what would happen? TP at this external, and let's see what happens. Right here, what happens? And we get stopped, right? So that is something that a lot of people don't really pay attention to. I see a lot of people making this mistake, but this is something that will save you a lot of losses if you just don't enter the trade. If we sweep the internal liquidity before inversing, it will save you so many losses. That's going to be it for this video. Thank you guys for watching. If you guys have any questions, leave them in the comments. If you guys have any video suggestions, leave them in the comments. Make sure you guys join the Discord. I'm in there every day. You guys can talk to me. And I'll see you guys later.